Welcome back to the deep dive. This is where we take a pile of, well, frankly, dense sources, and we try to strip out all the jargon to hand you the core ideas, the intellectual blueprint.
And today, we are going deep. We're getting into the engine room of investing.
We're talking about asset allocation. You'll hear it called AA. And this is not about which stock to pick. It's not about the hot tip of the week.
No, not at all. This is about the core structural integrity of your entire financial life.
That's a good way to put it. We're stepping back from all the noise, right? The day-to-day decisions, the individual security selections.
Exactly. And we're going to focus really intensely on the big picture, the macro structure. We're talking about the characteristics, the risk profile, and frankly, the discipline required for your overall portfolio.
Right. So our mission today is kind of fourfold. First, we need to actually define what this blueprint is. Then we have to understand the building blocks, what's actually available to you.
After that, we'll explore the 4 major strategies for how you deploy those blocks.
And then, and this is probably the most critical part, the misunderstood academic debates in all of finance.
Yeah. Yes, the infamous, and I have to say, often misused, 93.6% claim.
We'll get there. But first, let's start at the beginning. What is asset allocation?
At its heart, it's a philosophy. It's an investment strategy that tries to balance risk versus reward.
Okay, how?
By adjusting the percentage of each asset class in a portfolio. And it does that according to 3 main things.
Which are?
The investor's specific risk tolerance, their defined financial goals, and the time frame.
Yeah.
When they'll actually need the capital.
So it's the framework. It's what dictates the whole journey.
It is.
Yeah.
And this entire framework is built on something that's often called the single greatest advantage available to a regular investor.
Which is?
Well, it's the foundational justification for AA, and it comes straight out of modern portfolio theory, or MPT.
Right.
And the core idea is actually pretty simple. Different assets perform differently under different conditions.
So stocks do well in a boom, bonds might do better in a bust, that sort of thing.
That's the essence of it.
Yeah.
And this non-uniform behavior, that's what leads us to the concept of diversification.
The free lunch.
The free lunch, exactly. Nobel laureate Harry Markowitz famously called it the only free lunch you will find in the investment game.
A free lunch in finance is, well, it's almost unheard of. So why is diversification given that title? What makes it free?
It's because of a statistical property called correlation.
Okay.
Different asset classes, they have returns that are not perfectly correlated.
Meaning they don't move in perfect lockstep with each other.
Exactly. So if your stock portfolio is taking a huge hit because there's a recession, well, your bond portfolio might be holding steady, or it could even be going up in value because interest rates are falling.
I see. So the goal isn't to have everything go up at once.
That's impossible. No, the goal is to combine them in a way that lets you reduce the overall risk. And by risk, we mean the variability of your returns for a given level of expected return.
So you get a smoother ride over time.
A much smoother ride, without having to sacrifice your expected long-term outcome.
That makes perfect mathematical sense. You use assets that zig when others zag to sort of soften the blows.
That's the theory.
But, and this is a big but, I need to pause right here, because the sources we looked at, they immediately threw up a huge red flag, a massive caveat in this whole theoretical structure.
Yes. We have to introduce what we could call the major weak link in traditional AA.
The weak link, what is it?
While the theory of MPT and diversification is powerful, the way we actually implement it relies very heavily on looking backward.
Looking in the rearview mirror to drive forward.
A perfect analogy. We rely on statistical relationships, things like correlation, variance, historical returns that existed over some period in the past.
To try and forecast the future.
And that's the challenge, isn't it? You're feeding historical data into this machine that's supposed to map out a future that might behave in a completely different way.
So what happens when those historical relationships, break down? In a crisis, for instance.
That is precisely when the weakness gets exposed. There's this traditional technique for optimizing a portfolio. It's known as the mean variance optimization approach.
Sounds complicated.
It is, but the key thing to know is that it's extremely sensitive. It's the math that tries to map past volatility onto future risk.
Yeah.
But, and here's the kicker, if you get those initial inputs even slightly wrong.
The historical volatility, the correlation estimates.
Yes. If those are off by just a little, the recommended allocations can become, as the sources put it, grossly skewed.
Grossly skewed. Give me an example of what that looks like in the real world.
Sure. Let's say the optimization model mistakenly forecasts that some exotic asset class will have a slightly lower correlation with global stocks than it really does.
Okay.
The model might spit out a recommendation to put 60% of your entire portfolio into that one single asset.
Which is just, it's common sense that you wouldn't do that.
Of course not. It violates every rule of practical portfolio construction.
Right.
It's the classic garbage in, garbage out problem, but applied to market history. And it just confirms that AA is less about finding a single magic formula and much more about applying a prudent, sensible structure.
Okay, so if the structure is everything, we really need to understand the raw components we have to build with. Let's try to streamline the menu of options and focus on the behavioral role of these assets.
Good idea. Let's start with the traditional trio.
The 3 pillars.
Stocks, bonds, and cash. And when you're building this AA blueprint, you're not supposed to be thinking about, say, Apple versus Microsoft. You should be thinking about the risk function each asset class performs in the portfolio.
Got it. Let's start with stocks or equities. What is their fundamental role in this structure?
They are the growth engine. That's it. They're the primary source of your long-term returns, and just as importantly, they are the major contributor of your portfolio's volatility.
The bumps in the road.
All the bumps in the road. And within equities, the really key behavioral distinction isn't so much microcap versus large cap. It's more about the underlying style.
Style.
Yeah. You have growth strategies, which are all about pursuing companies focused on rapid expansion. Think high-flying tech.
And then the other side of the coin
is value strategies. These focus on companies that are trading cheaply relative to their intrinsic worth.
Yeah.
More established, maybe less glamorous businesses.
And geographic location, that has to play a huge role in diversification.
Oh, an absolutely massive role.
Yeah.
Your domestic equities, so for us U.S. equities, they provide the core. But you have to look globally. You have developed markets.
Europe, Japan.
Right. And then you have the much higher risk, higher potential return categories of emerging and even frontier markets.
And the benefit there is that their economies aren't moving in sync with ours.
Exactly. The economic cycles, the currency risks, they are not perfectly tied to your home market. That's the diversification benefit right there.
Okay, next up, we have bonds or fixed income. So if stocks are the accelerator,
then bonds are the structural support. They're the brake. They are debt instruments. You're essentially lending money. And their main purpose is capital preservation.
So safety first.
Safety, providing income, and this is the most important part, acting as that counter-cyclical stabilizer when your stocks are taking a nosedive.
And we classify them by who's borrowing the money?
Correct. You have government bonds, which are usually the safest, versus corporate bonds. And risk matters hugely here, too.
How so?
Well, you have your investment-grade bonds, which are issued by very stable companies or governments. And then you have high-yield bonds.
Also known as junk bonds.
Also known as junk bonds, yes. They have to pay much higher interest rates to compensate investors for the much greater risk of default.
And the other factor is time, right? Duration.
Yes, duration, which we often simplify by just looking at the time frame. Short-term, intermediate, or long-term maturity bonds.
And the simple rule is?
Shorter duration bonds generally have a lower yield, but they also have much lower interest rate risk.
Okay, finally, the bedrock. Cash and cash equivalents.
This is the truly defensive asset. This is your safety blanket. Think about standard liquid deposit accounts or money market funds.
What's its function in the blueprint?
Its main function is to provide liquidity and, crucially, optionality.
Optionality, what do you mean?
When markets are crashing all around you, having cash equivalents means you have dry powder. You have the ability to rebalance your portfolio and buy those risky assets, like stocks, when they're cheap, without being forced to sell other things that are also falling in value.
It's the buy low part of the equation.
It enables the buy low part. Without it, you're just a forced seller.
Okay, let's look beyond the standard 60-40 mix for a minute. Let's talk about the universe of alternative assets. Why are these suddenly so popular, especially in big institutional portfolios?
Well, they're popular for one main reason. They are actively sought out for their low correlation with the traditional stock and bond markets.
So they zig when everything else sags.
That's the hope. They offer different kinds of risk premiums. We can probably group these alternatives into 3 major functional buckets, just to keep it simple.
Okay, bucket 1.
Bucket 1 is tangible assets and inflation hedges. This includes physical things like precious metals, gold is the classic example, or even valuable collectibles like fine art or rare stamps.
And their value isn't tied to corporate profits.
Right. Their performance is often linked to things like inflation expectations or general economic uncertainty. So they're a direct hedge against your currency losing value. not against the stock market's performance.
Makes sense. Bucket number 2.
Real assets. This is primarily real estate, commercial or residential. You can own it directly or through more liquid things like REITs, which are real estate investment trusts.
You could buy them just like a stock.
Exactly. And this bucket also includes things like infrastructure projects, pipelines, airports, utilities.
And the appeal there is steady cash flow.
Stable, often inflation-adjusted cash flows. Again, a very different risk profile than public company stocks.
All right, and the final bucket. This is where things get a bit more specialized.
This is the deep end of the pool. Complex financial instruments and private markets. This is where the big endowments and pension funds really operate. It includes venture capital and private equity.
So investing directly in companies that aren't on the stock market.
Yes. And it also includes complex derivatives like options and futures or some very, very specialized instruments.
Speaking of specialized, I want to go back to that bizarre example we found in the source material, the catastrophe bond.
Oh, that's a fascinating one.
Explain why it's the perfect example of a truly non-correlated asset.
Okay, so a catastrophe bond, or a CAT bond, is a debt security. But the repayment of your principal is tied to a specific non-market related event, like a major earthquake in California or a Category 5 hurricane hitting Florida.
So your investment is basically a bet on the weather.
Or on geology, yes. You get a very high yield for taking on that risk. But think about it. The stock market could be having its best year in a decade. But if a massive hurricane makes landfall in Miami, you could lose all your principal.
And the opposite is true.
The opposite is true. The market could crash 30%. But if the weather is calm and the earth doesn't shake, your bond is perfectly fine. Its risk driver has absolutely zero correlation with the S&P 500.
Wow. That really does illustrate the point perfectly. The goal of alternatives is to find risk that isn't tied to the global economy.
That's the holy grail for diversification.
Okay, so now that we have all the assets, we need a way to classify them based on their behavior, because that ties directly into the strategies we're about to get into.
And that brings us to the industry classification context. It's a functional way of looking at stocks, often using something like the Morningstar X-ray structure to see how entire sectors of the economy respond to the business cycle.
And this is critical for the more active allocation strategies.
Absolutely essential.
So the first group is defensive.
Right. Defensive sectors are the ones that maintain relatively stable demand no matter what the broader economy is doing. These are the essentials.
Things we can't live without.
Exactly. Consumer staples, so groceries, toothpaste, cleaning products, healthcare, and utilities. When people get nervous about a recession, they tend to pile into defensive stocks looking for safety.
Okay, what's the next group?
The sensitive group. These sectors are, well, sensitive to the general pace of the economy. They react pretty sharply to changes in sentiment or small shifts in interest rates.
So what's in this bucket?
This includes energy, industrials, technology, and telecommunications. They're not exactly recession-proof, but they are generally less volatile than our last category.
In that last category, the most volatile players are the cyclical assets.
Correct. Cyclical sectors are entirely dependent on the economic boom cycle. They thrive when people have a lot of disposable income and when credit is cheap and easy to get.
So we're talking
Consumer discretionary luxury goods, travel, new cars, basic materials, so mining, construction materials, financials, banks, brokerage firms, and real estate.
So if you bet heavily on cyclicals, you are making a big bet on continued economic expansion.
A very big bet. The moment you start classifying assets like this, you're already thinking about strategy.
Which is the perfect transition point for us.
Exactly. Understanding those behavioral buckets, defensive, sensitive, cyclical, it really is the foundation for applying the 4 major allocation strategies we're going to talk about.
And these strategies, they mostly differ based on their time horizon and, I guess, how much they're willing to fiddle with the plan.
Their willingness to react to market noise is a good way to put it.
Okay, let's start with the most disciplined approach, the one that's, most often recommended for long-term investors. Strategic asset allocation.
Strategic AA is the anchor. Its one and only goal is to create an asset mix that targets the optimal balance between expected risk and return over a very long time horizon.
We're talking decades.
We're talking 20, 30 years, yes. And its key characteristic is stability. It is almost entirely agnostic to what the market is doing this month or this year.
Okay, so let me see if I have this right. If I decide my long-term plan requires, say, a 70% stock and 30% bond mix based on my age and when I want to retire, I'd just set that policy and stick with it.
You stick with it,
Yeah.
regardless of whether you think the stock market is overvalued or undervalued this quarter.
The set it and forget it approach.
It's often called that. But the only active management you're really doing is rebalancing.
Which is?
Selling the assets that have grown too much.
Yeah.
Let's say stocks have had a great run and now they're 75% of your portfolio. And you use that money to buy the assets that have shrunk, the bonds that are now at 25%, to pull the whole thing back to your original 70-30 target.
That sounds like it forces you to sell high and buy low.
It's a systematic, disciplined way to force yourself to sell high and buy low. It's a crucial behavioral safeguard.
Okay, that makes sense. But what if the long-term fundamentals of the economy itself change? That feels different than just a market correction.
And that is exactly where dynamic asset allocation comes in.
Guess how is it different?
It's similar to strategic because it's still built for the long haul. It maintains exposure to the same core asset classes. But the key difference is that dynamic portfolios will adjust their postures over time.
In reaction to what?
In reaction to significant structural shifts in the economic environment.
Give me an example of a structural shift, not just daily volatility.
Think about multi-year changes.
Yeah.
A great example would be if central banks around the world commit to a decade of near-zero interest rates.
Which they did.
Which they did.
Hmm.
That fundamentally alters the expected long-term return and the risk profile of fixed income, of bonds. A dynamic manager might see that and decide to slightly decrease their long-term bond allocation and maybe increase their allocation to some alternative assets to try and compensate for that lost yield potential.
So they're reacting to big tectonic shifts in economic regimes.
Exactly. Not just whether the S&P 500 is up or down this week.
Okay, so strategic ignores the noise. Dynamic adapts to the tectonic plates. Now we get to the approach that seems to live entirely in the noise. Tactical asset allocation.
That's a perfect description. Tactical AA is really the active trader's game. It's designed to try and capture what are perceived to be short-term mispricings or temporary market imbalances.
So they're trying to time the market.
In a very deliberate, systematic way. The goal is to move the portfolio into specific assets or sectors or even regions that they believe will outperform over the next, say, 6 to 18 months.
Okay, so if a tactical manager believes a recession is imminent, what do they do that a strategic one wouldn't?
Well, the strategic portfolio, the 70-30, it does nothing. It sticks to the plan.
Right.
The tactical portfolio, seeing a recession on the horizon, might slash its equity allocation from 70% all the way down to 40%. It might increase its cash position to 30% and shift the remaining stocks almost entirely into defensive sectors like utilities and healthcare.
So they can make huge moves.
They are free to move entirely in and out of their core asset classes, all in the search for a temporary advantage. The big risk, of course, is that you're constantly citing the tendency to get it wrong, to buy high and sell low because of poor timing.
That sounds exhausting. And probably really expensive with all that trading.
Yeah, it can be both.
Which leads us to what sounds like a smart blend of these ideas. Core satellite asset allocation.
Yes, core satellite is a hybrid approach. It's built specifically to get some of that opportunistic potential while mitigating the huge risk of tactical errors. It tries to balance stability with opportunism.
How does it contain the risk?
The structure itself contains the risk. The core of the portfolio is the strategic element. It makes up the vast majority of the portfolio, maybe 70 or 80%.
And that core is?
It's highly diversified, typically very low cost, often passively managed, and it's completely dedicated to that long-term risk profile. It's the anchor.
And the other 20%.
That's the satellite portion.
Yeah.
And that's where you can make your dynamic or your tactical adjustments. It's your play money, in a sense.
So if your tactical bet on emerging markets goes wrong,
the core of your investment is protected and just keeps compounding away. It lets an investor try to seek alpha, that's excess returns, without betting the entire farm on their ability to predict the future.
it sounds like the best of both worlds.
It can be, but only if the investor maintains really strict discipline to keep that core dominant. It's an admission that while tactical skill can sometimes add value, the overall structure, the core AA, has to remain the primary driver of the portfolio's long-term return and volatility.
All right, now we get to it. The great intellectual friction point in modern finance. The numbers that, well, everyone seems to know, but almost nobody correctly understands.
Yes, we are talking about the BHB study, Brinson, Hood, and Biebauer from 1986, the study that gave birth to that infamous 93.6% claim.
So this is basically the origin story for the idea that your strategy matters way more than your stock picking.
It is. They looked at 91 large U.S. pension funds over a decade, from 1974 to 1983, and they asked a very simple question.
Which was?
How much of these funds' quarterly performance was because of their policy decision, their asset allocation mix versus their active decisions. The specific stocks and bonds they picked and their market timing.
Okay, and how on earth did they separate the two? How do you isolate the policy?
They ran a thought experiment, a clever one. They took the actual returns from these actively managed pension funds, and they hypothetically replaced all the individual holdings, every stock, every bond, with simple passive market indexes that corresponded to the fund's asset allocation policy.
So they basically stripped out the manager's skill, or lack thereof, completely.
Completely.
And what was the headline finding from that?
There were two big ones. First, the passively indexed hypothetical quarterly return series was actually higher than what the actively managed funds really returned. And that was before you even accounted for management fees.
Wow. So the managers, on average, were actually subtracting value during that period.
Emphatically, yes. But the finding that really changed the industry was the statistical relationship they found between the two return series.
The actual returns versus the passive policy returns.
Exactly. The statistical correlation between them was massive. It was 96.7%. And here's the number that has echoed through finance ever since. The shared variance was 93.6%.
And they did a follow-up study, right?
They did in 1991, and it confirmed a very similar shared variance of 91.5%.
Okay, this is where the confusion begins, because when people hear 93.6% shared variance, they immediately conclude, aha, asset allocation explains 93.6% of my total investment return.
They do.
But if that were actually true, why would active managers or strategists or analysts even exist? It would all be pointless.
It would be. And it's because that conclusion is a fundamental statistical misinterpretation, especially when you apply it to your cumulative wealth over time.
So what does the statistic actually show?
It demonstrates the similarity of the two return series, especially in terms of their volatility and their movement from quarter to quarter. The original authors themselves, they had to come out later and clarify that their focus was always on correlation and volatility, not on explaining long-term cumulative performance.
Correlation does not equal performance explanation.
Not in this context, no.
And this, of course, led to some major pushback. I'm thinking of William Jahnke's famous paper, The Asset Allocation Hoax. What was his main criticism?
Jahnke's core argument was that using quarterly data artificially inflates that correlation number.
How so?
Well, think about it. If you're comparing two very similar portfolios over a very short time frame, like 3 months, their movements are going to look incredibly similar just because they're both being buffeted by the same broad market forces.
So using short-term data hides the small differences.
It dampens the impact of small but compounding differences in return. If manager A and manager B both have a 60-40 allocation, sure, their quarterly movements will look almost identical, maybe 96% correlated.
Right.
But if manager A has a 0.5% lower annual cost over 20 years, or if they consistently make a slightly better call on just 1% of the portfolio, those tiny differences compound into dramatically different final wealth totals.
And the correlation metric just doesn't capture the power of that compounding over time.
It doesn't. The volatility looks the same, but the final outcome is not. We need a better way to distinguish what AA really explains.
Which brings us to Ibbotson and Kaplan, who stepped in with their 2000 study to provide a much clearer statistical breakdown. What did they find when they looked at 94 mutual funds?
Well, first they found a similarly high correlation, a shared variance of about 81%. But their analytical distinction is really the Rosetta Stone for this whole debate. They separated the impact of AA into two distinct categories.
Okay, what were those two categories?
Okay, first they found that AA explained only about 40% of the variation of returns across different funds.
What does that mean, across funds?
That 40% is the difference in returns you see between, say, Fund A that focuses on large cap stocks and Fund B that focuses on small cap stocks. The other 60% of the difference is due to the manager's active choices, stock selection, timing, and most importantly, costs.
So strategy explains why the funds behave differently, but only accounts for 40% of the performance difference between them.
Right. But here was their second and absolutely critical finding.
Which was?
They found that AA explained virtually 100% of the level of a fund's returns.
Wait, that sounds like a contradiction. How can it explain 100% of the level, but only 40% of the variation?
It does sound tricky. Let's use a metaphor.
Please.
Imagine you decide to drive from New York to Los Angeles. Your asset allocation decision is your choice of vehicle. Are you going to take a high-speed sports car, let's call that an 80% stock allocation, or a reliable low-risk van, a 20% stock allocation?
Okay, sports car is faster, more exciting, but more prone to accidents and uses expensive fuel. The van is slower, but safer and more efficient.
Perfect. The level of your return is the inherent speed limit of your chosen vehicle. The sports car level means you expect to arrive in, say, 4 days. The van level means you expect it to take 6 days. That basic expectation, the bulk of your journey's time, is 100% dictated by which vehicle you chose at the start.
Got it. So my choice of 70% equities, that dictates my expected long-term return profile. That's the level.
That is the level. Now, the variation, that's the 40%. That's whether one driver gets slightly better gas mileage, or finds a faster route for a couple of hours, or hits some unexpected traffic.
It determines if I show up a few hours earlier or later than expected.
Exactly. But it doesn't change the fundamental 4-day versus 6-day expectation that was set by the vehicle. The AA choice is about setting the expectation.
That is a huge distinction. So the number we should really care about isn't the 93.6% volatility correlation. It's the 100% impact that AA has on defining our long-term return level.
Precisely. And that this idea was crystallized even further by Mir Statman's work, which looked at all this through the lens of the efficient frontier.
The efficient frontier, that's the curve that maps out the best possible return for any given level of risk.
It is. And Statman showed that strategic AA is simply choosing a point along that frontier. You pick a risk level you can tolerate, say 10% standard deviation, and you accept the corresponding expected return that the market offers for that risk.
But tactical AA, the active approach, is trying to do something completely different.
A tactical manager is trying to predict market anomalies. They are effectively trying to shift the entire efficient frontier upward.
So they're saying,
for that same 10% level of risk, I believe my temporary tactical moves can earn a higher return than what the market average offers. They're trying to move the whole possibility set.
And did Statman's analysis show if that was possible? Did tactical skill add value?
Hypothetically, yes, in a big way. Statman ran a simulation where a tactical advisor had perfect foresight. They knew exactly when to shift between stocks and bonds to maximize their gains.
And what was the result?
This perfect tactical advisor performed 8.1% better per year than the purely strategic set-it-and-forget-it approach.
8.1% annually. That's a game-changing amount of alpha.
It's enormous. But here's the punchline, and it brings us right back to the discipline requirement. Even with that perfect tactical manager adding 8.1% of outperformance every single year, the boring, static, strategic AA policy still explained 89.4% of the return variance.
So even with a perfect manager, the structure still governed the volatility.
The structure still governed the volatility and the expectation. Tactical skill is incredibly valuable if you possess perfect foresight, but the strategic choice is still the dominant risk factor in your portfolio.
Okay, so the synthesis for you, the listener, is this. Asset allocation explains 90% or more of the volatility of your returns, and basically 100% of the expected level of your returns. It's your primary risk containment tool.
But it does not explain your final ending wealth entirely. That's where things like timing mistakes, cost efficiency, and active compounding can add or subtract significant amounts over the decades.
Let's just briefly wrap the academic side with a look at modern research, specifically the global market portfolio.
Yes, this comes from work by Duswick, Lamb, and Swinkles.
So what exactly is the global market portfolio? Why do researchers see it as the ultimate benchmark?
The GMP is, in theory, the portfolio of the average investor in the entire world. It includes the relative value of every single globally traded asset, all the stocks, all the bonds, all the real estate, commodities, everything.
So it's the total investable universe.
It is. And because of that, many financial experts argue it's the optimal portfolio for the average, totally diversified investor who has no special information or insight.
What does that optimal benchmark look like in terms of long-term returns?
Well, their data shows that from 1960 all the way to 2017, the global market portfolio realized a compounded real return of 4.45% per year.
Real return, so that's after inflation.
After inflation, and it did that with a standard deviation or volatility of 11.2%.
That 4.45% real return over nearly 60 years, that feels like a really powerful anchor for setting long-term expectations.
It is. And it also highlights the impact of those huge structural economic regimes we talked about. During the high inflation period from 1960 to 1979, the real return was only 3.24% per year. But then during the disinflationary period from 1980 to 2017, it jumped up to a really robust 6.01% per year. Your asset allocation policy needs to be strong enough to survive those massive multi-decade shifts in economic reality.
Okay, so we've established that asset allocation is all about structural control. It's about managing volatility. But A structure is completely useless without implementation.
And implementation is governed by human emotion.
Exactly. This shifts us from the quantitative theory to the behavioral reality. And that starts with the single most important decision, the return versus risk trade-off.
This is the choice of the vehicle we talked about. The sports car versus the van. The stock versus bond ratio is absolutely paramount. It determines how much potential long-term growth you're aiming for versus how much inevitable short-term pain you must be willing to endure to get there.
And it is so easy to say, oh, I have a high risk tolerance when the market is going up 20% a year.
So easy.
But the sources we read really stress that your true risk tolerance is only revealed under duress when you're losing money.
That is the hard truth of investing. Simply buying a high stock allocation without realistically modeling what the worst-case scenario looks and feels like can lead to the very outcome AA is designed to prevent,
Which is
panic selling. The key is to choose an allocation that you can mentally and emotionally hold on to through a severe market drawdown.
Let's use some dramatic data to illustrate this. Let's look at the 2000 to 2002 bear market. This was the dot-com bust, a brutal period for tech and growth stocks.
That period perfectly isolates the critical importance of the stock-bond mix. Let's consider the highly aggressive investor, the one who chose the growth-focused sports car.
Let's say a portfolio of 80% stock and 20% bond.
Over that 3-year bear market, that portfolio suffered a cumulative return of negative 34.35%, and that's after inflation.
A third of your money gone. That is the moment where behavioral discipline just shatters. That's when an investor starts reading scary headlines and panics, locking in those losses forever.
Now let's contrast that with the conservative investor, the one who valued stability and chose the van, a portfolio of 20% stock and 80% bond.
Okay, what happened to them?
That portfolio ended up with a positive cumulative return of plus 6.29% after inflation during the exact same period.
Wow. A 41 percentage point difference in capital preservation, just from that foundational choice of the AA blueprint. The 80-20 investor was subjected to genuine financial trauma.
While the 2080 investor actually made money simply by staying invested, that is volatility management in action.
But we have to respect the trade-off.
Absolutely. Because if we look forward, the projected 10-year cumulative returns are starkly different. That 80-20 portfolio might project a 52% cumulative gain, while the 2080 portfolio only projects a 24% gain.
So the aggressive investor is accepting that massive short-term pain for the potential of doubling their long-term wealth gain.
Exactly. The true art of AA is defining the amount of pain you can stomach without selling, to make sure you stay on the road long enough to actually reach that higher potential reward.
Which brings us to the next operational aspect. If we get the allocation right, what about the specific funds we choose within that allocation?
A very important question.
So let's talk about performance indicators, and specifically the reliability of low cost. There was a study by McGuigan that showed how hard it is to just pick a winning fund based on its past results.
It's incredibly difficult. McGuigan looked at all the funds that were the top 25% of performance during the decade, from 1983 to 1993.
The winners.
The winners. Then they followed them for the next decade. And they found that only 28.57% of those top funds managed to stay in the top quartile.
So more than 2/3 of the winners became average or worse.
They dropped significantly in rank. Past performance is a highly unreliable indicator of future results.
So if past success is unreliable, what factor is consistently reliable?
The conclusion from John Bogle, which really applies universally to structured investing, was that low cost was a more reliable indicator of superior performance.
How so?
When he studied funds, the lowest cost quartile consistently delivered the best performance, and the highest cost quartile consistently delivered the worst. The reason is simple. Cost is the only predictive factor you know for certain in advance.
Every dollar you pay in fees is a dollar that can't compound for you.
Exactly. Regardless of how brilliant the tactical manager believes they are, when your asset allocation is dictating the overwhelming majority of your return level and your volatility, then minimizing the cost friction on that plan becomes paramount.
The AA plan is the blueprint, and cost is the tax you pay on that blueprint.
A perfect way to put it.
This leads us to our final and I think most crucial discussion point, the 9 core problems with asset allocation. These are the real-world, human, and practical challenges that can completely derail even a theoretically perfect AA plan.
We've established the failure is usually behavioral, not mathematical. This is where the rubber meets the road.
Right. And the most important takeaway here is that the plan is only as good as the investor's ability to actually stick to it.
100%.
Let's start with the unavoidable elephant in the room, behavioral bias.
Investor behavior is just. It's fundamentally biased. We're driven by fear and greed. We anchor to recent outcomes. We exhibit herding behavior. We follow the crowd. And we feel the pain of a loss far more acutely than the joy of an equivalent gain.
And this is a direct challenge to the disciplined rebalancing that a strategic AA plan requires.
It's a huge challenge. When stocks are soaring, every instinct in your body is screaming to buy more, not to sell them, and bring your portfolio back to its target allocation.
And the related issue is the instability of the core premise itself, changing risk tolerance.
Your risk tolerance is not a fixed number you write down on a form. It's an emotional state. When an investor first signs up for an AA plan, they might agree to a 70-30 split.
Sounds about right.
But after 5 years of 15% annual returns, they start to think, you know what? I can handle 90% stocks. I'm invincible.
And the opposite happens in a crash.
The exact opposite. If they experience that 2000-2002 bear market and they see that negative 34% loss, they immediately want to shift to a 20-80 portfolio and never own a stock again.
So the lesson is that your risk tolerance is not knowable ahead of time.
It's not. It is only tested and potentially changed by real-world market experience. And that change in tolerance leads directly to violating the AA policy, usually at the worst possible time.
Buying high and selling low.
It's often the direct result of an emotional change in your perceived risk tolerance.
Okay, next problem. Let's look inside the portfolio itself. Security selection mismatch.
Right. Even if you stick to a perfect 60% equity policy on paper, if you use that 60% to buy a very concentrated selection of, say, 4 highly speculative small-cap growth stocks,
You've subtly subverted your own plan.
you have. Your portfolio will now behave far more volatilely than the broad 60% U.S. large-cap equity category that your AA plan originally assumed. The policy requires broad diversification within each asset class to make sure the risk profile matches the assumption.
Then there's the friction between our lives and our plans. Time horizon mismatch.
The great strategic benefit of asset allocation is realized over 20 or 30 years. That's the whole point. However, if an investor suddenly needs a big chunk of that money in 2 years, maybe for house down payment or a child's tuition, they now face a time horizon mismatch.
A short-term correction could be a disaster.
A short-term correction, which a long-term plan is designed to just ride out, could force that investor to liquidate assets at a big loss, completely destroying the long-term premise of the plan.
Which is why short-term money needs to be in safe assets.
Capital required in the short term must be allocated to cash and short-term fixed income, regardless of what your overall long-term ABA policy is.
Okay, moving to structural issues. Tax and regulatory complexity.
A simple 60-40 mix becomes infinitely more complex when you start thinking about tax efficiency. You've got real estate, foreign bonds, assets held in tax-advantaged retirement accounts versus your regular taxable brokerage account.
And each category is treated differently by the tax code.
Completely differently. And optimizing your AA for tax efficiency can be incredibly challenging. Sometimes investors will compromise the entire structure just to achieve tax simplification, which is itself a structural failure.
And linking back to Bogle's findings, the inevitable drag of cost and fees.
Frequent rebalancing is mandatory. You have to do it to maintain the integrity of the AA structure. If your stocks run up, you have to sell them to buy bonds to get back to your target.
And all that trading costs money.
That act of trading, especially if you're doing it with high-fee mutual funds or brokers, generates substantial transaction costs and management fees. And those frictional costs directly erode your returns over time. It just shows why complexity and high costs are the enemies of a successful long-term plan.
And finally, the allure of the quick win, the siren song of the market, poor timing.
This is the failure of the tactical approach in the hands of most investors. Accurately predicting the optimal times to move in or out of specific asset classes is one of the most difficult things to do consistently in finance.
You have to be right twice.
You have to be right twice. If you try to switch from defensive sectors to cyclical sectors because you anticipate a boom and you're 6 months too early, you end up sitting in highly volatile, poorly performing assets, racking up costs, and sacrificing the compounding of your strategic core. Poor timing adversely affects returns far more than almost any other non-behavioral factor. So we have completed a pretty comprehensive deep dive today. We've moved all the way from the foundational theory of diversification to the painful reality of human implementation.
And to synthesize it all, asset allocation is your portfolio's structural blueprint. It's fundamentally defined by your goals, your time horizon, and most importantly, your proven, battle-tested risk tolerance.
We explored the four main strategies, but the key takeaway has to be the supremacy of that strategic approach as the stable core of any plan.
And we did it. We finally resolved the great academic debate. The crucial lesson from that whole BHB study is that AA governs the volatility and the level of returns. It provides the necessary risk containment.
Get the allocation right, and you define a risk profile that you can actually live with. And that allows you to endure the inevitable market downturns without panicking.
But defining that structure, it requires the utmost behavioral discipline to actually stick to it, to ignore all the market noise, and to resist that primal instinct to chase performance or to flee from fear.
Which brings us right back to that ultimate passive benchmark, the global market portfolio.
Right.
We noted that this globally diversified average, the portfolio of the average world investor, realized a very respectable compounded real return of 4.45% per year over almost 6 decades.
And it provided that resilience across massive inflationary and disinflationary economic shifts.
It did.
So here is our final provocative thought for you to consider. Given that the global market portfolio represents the optimal benchmark for the average globally diversified investor, and recognizing the 9 powerful human and practical obstacles that routinely cause active or tactical AA to fail, how should you use this market-wide average?
Should you perhaps adopt the GMP's structure, the composition of all the world's assets, as the immutable, passive, low-cost core of your personal strategic allocation, and only deviate from it minimally to suit your specific personal liquidity needs?
By using the GMP as the baseline, you essentially neutralize all those difficult emotional decisions of security selection and market timing.
And you allow the natural resilience of global diversification to do its work, while maximizing your own behavioral discipline over a decades-long time frame. It's food for thought for your own blueprint.
That's a wrap on the deep dive. We'll talk to you next time.